Well, Asia is connected into the global economy, so it's not immune. However, there are some mitigating factors, not least the fact that over the past few years in particular, internal demand from within the region has been a much bigger factor in the GDP growth that the region's been experiencing. So that's a mitigator, but at the end of the day, Asia's connected both economically and also through the financial markets to what's going on in the States and what in particular is going on in the Eurozone. And so it's very much the case that in the short term at least, financial markets in this part of the world will be connected and will mirror what's going on elsewhere in the world. Well, it's an interesting one because if you look at the major liquid asset classes, most of them are very expensive at the moment. If you look at cash is expensive in most markets, particularly in real terms after inflation is taken into account. Bond markets are very expensive. Yields are in many countries at all-time lows. Property markets are expensive. And in fact, interestingly, the only major asset class that you could argue is not expensive is equities. But the issue with equities is that equities have been particularly volatile. They're perceived, and they are indeed a risk asset. They're perceived as such. And therefore, notwithstanding the fact that valuations in equity markets on many different measures, whether you're looking at price to book or yield or earnings, they're cheap, equity markets, but they're not actually performing, and that's simply because of risk aversion and the fact that investors are seeking protection of capital in these uncertain times. Well, it's highly dependent on what you mean by medium term, and it's highly dependent on what happens in the next several months in Europe in particular. If in Europe issues resolve themselves, which is going to take, I think, at least a year or two, one way or another, whatever the solution ends up being, it's at the end of that period of adjustment, then I think equities, there's plenty of room for them to do very well, particularly because they are on many measures so cheap. But in the meantime, with all the uncertainty and with the pain that whatever solution in Europe the politicians come up with, there's going to be a price to pay for that, means that equities are going to remain volatile for quite some time. And so the key thing is to focus on the equities that are defensive in nature, equities that can provide a good fixed return in the form of dividends in particular. And our analysts and portfolio managers, because of their bottom-up approach, are well placed to identify those sort of specific pockets of opportunity, pockets of growth, and individual stocks that can do relatively well in this environment. As most people know, Fidelity doesn't have a sort of a top-down approach to the way it looks at sectors and stocks and markets, and indeed. The individual portfolio managers at Fidelity are free to find returns for their clients in whatever way they want within appropriate guidelines and risk parameters. And so if you look at any individual portfolio manager, there's quite often different things going on. But to the extent that there is sort of commonality, I think it's fair to say that as far as countries in the region are concerned, there's quite an emphasis on the Southeast Asian markets, the ASEAN markets in particular, to even in China, notwithstanding the fact that the market there is slowing down, there's some specific opportunities there too. And in terms of sectors, there's still very much the consumer play is still there. I mean, there's still huge spending power, very favourable demographics, and if you look across portfolios, you will see plenty of stocks which reflect that fact. And so if you're looking sector-wise, stocks that play to the consumer demand theme are often to be seen in portfolios. Although the China market itself hasn't done well of late, there's more than one way of playing China. I mean, China has a big influence on many companies in the region, and there are many companies that are actively engaged or indeed have ownership of onshore companies in China. So just because the official China index isn't doing well doesn't mean to say that one can't take advantage of the opportunities there, quite often by looking beyond just the obvious in order to get exposure. And indeed our portfolio managers in the region, if you look at their portfolios, there's a lot of that going on in the portfolios which may not be immediately obvious because they're not necessarily Chinese stocks, but they've got significant earning streams and significant ownership of or exposure to in one way or another to the China story. It's always hard to predict short-term economic policy in any country. I think India is in something of a bind because the currency's obviously been extremely weak. Inflationary pressures until relatively recently have been pretty strong, with the oil price in particular being where it's been. And so I think the Indian government is slightly caught between a weak currency on the one hand and needing to stimulate the economy on the other. But I'm not sure that interest rate cuts are necessarily the whole answer in India. I think what's really required is a bit of political leadership and a political decisiveness. So some of the reforms and subsidies and the attitude to foreign investment, that sort of stuff needs addressing. Well, Indonesia is, it's a great long-term story. It's a new democracy. It's a fantastically blessed country in terms of resources. Its demographics are fantastic. 250 billion people with an average age, I think, in the mid-20s. But there are some more worrying things more recently internally, which one hopes will not sort of play out. In particular, sort of bottlenecks in infrastructure which need sorting out. As far as the second half of this year is concerned, I think it's going to be very much determined, I'm afraid, by what's going on outside the region. Having said that, if markets do actually weaken considerably for reasons that are not directly to do with Indonesia, for a long-term investor, that actually I think will provide some very interesting opportunities for that market, because, as I say, the long-term prospects are for the reasons I've stated, very exciting potentially for that country. Well, the Australian market, it's a very interesting market. It's got the highest yield of any market in the region, currently around about 5.5%. It's a very secure yield because corporate balance sheets are in good shape, and there are many good things that one can say about the market. However, there's definite sort of a lack of retail confidence, evidenced in pretty weak retail spending and weak confidence numbers. There were very strong GDP numbers which were announced yesterday, but I somehow wonder whether they are sustainable if the Eurozone difficulties drag on in the way that I think they're likely to for the next 2 to 3 years. And so I think that I think that we should be prepared for a period of weakness. Having said that, there's some great individual opportunities, and there's some fantastic opportunities if what you're interested in is income, because in this market, with an average yield of 5.5%, there are plenty of good quality companies which have yields of significantly above that average, so 6, even 7%, which can form part of a portfolio, and which will carry you over this period of uncertainty and allow you to make good money from an income stream, and hopefully down the line, when markets recover, also make a capital gain too. I think our bottom-up process is ideally suited to it, actually, for a couple of reasons. First of all, with so much macro uncertainty, so much political uncertainty driving markets, the only way you can build conviction and build certainty is actually looking at what's happening on the ground, and the bottom-up process that we use, both in terms of stock picking, but also in terms of going out into the field and actually working out what's going on in individual countries at ground level, is the best way, and I would argue possibly the only way right now to build any kind of certainty in a very uncertain world. And I think the other thing to say is there's a lot of noise out there, a huge amount of noise, and having our own independent in-house research capability, which is very substantial, is very important, because that allows our portfolio managers to cut through the noise and focus on what our guys are saying internally. And I think that makes it a lot easier to build conviction when looking at portfolios. So I think that bottom-up process, the fact that we're able to sort out the wheat from the chaff in that way is very important and quite unique, actually, to our investment process.